Are you about to get rich investing in Google and Amazon right before the huge stock split coming? Because after all, on February 11th, Google announced a 20-for-1 stock split that will take place on July 15th. You'll have to have your shares before July 1st. And just a month later, Amazon announced a similar 20-for-1 stock split scheduled for June 6th. You'll have to have your shares before May 27th. This means that shares trading for roughly $2,800 will trade for roughly $140 per share. And this brings back fond memories. In the summer of 2020, Apple and Tesla both announced stock splits. Apple shares, after the stock split announcement, rallied 36% leading into the stock split, and Tesla skyrocketed an insane 66% leading into the stock split. So we should definitely go all in on Google and Amazon, right? Well, let's talk about that. First, what is a stock split? And second, should you actually go all in on these stocks, expecting an Apple and Tesla style skyrocketing? Well, first, remember that a stock split doesn't change the actual underlying value of the company. It just means that rather than a company selling you a pizza that's 20 inches and is a supersized pizza, way too much for you to eat, maybe it's just way too expensive or whatever, they're just gonna sell you one slice or 1/20th of that bigger pie of pizza. So you're just getting a smaller share for a smaller price. Nothing's changed here. It's just like paying $20 for the pie or $1 for the slice. There's no discount for larger sizes. But why then do the stocks tend to run up like Apple and Tesla did? And should you invest in Amazon and Google before the split? Well, stocks tend to go up due to social momentum and hype. Simply put, a lot of folks like to speculate that a stock will do well going into a stock split. And because folks speculate that the stock will do well, the price actually tends to go up, reinforcing the belief that stock splits make prices rise. Consider this. Just after Google announced their stock split, their stock was up 8.95%. It almost hit $3,100 from a low of $2,495 just a few days before that. This, for a $1.7 trillion company, is a huge movement. Unfortunately, once the split actually happens, the stocks tend to go down. For example, look at Apple and Tesla. When Apple and Tesla split their stocks on August 31st, 2020, both of their stocks started plummeting about 4 days later on September 4th. They fell and gave back about 60 to 70% of their gains. So the theory here has always been, okay, buy the rumor of the stock split or buy the news of the stock split and then sell the actual happening, sell the event. This is the classic end to any momentum trade. If you're not out quickly enough, you end up getting left holding the bag. Now, fortunately, in the case of Apple and Tesla, they're great companies, and those stocks are now worth more than before the split and after the split. So if you held, you'd come out ahead anyway. But can you ride the Amazon and Google split up just like Apple and Tesla? Maybe not. Why? Because our market is really different now. Remember how I mentioned that Google stocks skyrocketed after the announcement of the split, reinforcing the argument that stocks go up before a split? Well, Google basically immediately sold right off again, and the split hasn't happened yet. So what's going on? Well, what's happening is we're in probably the most uncertain environment for investors. And any increase in prices just gives investors, whether they're retail or institutions, an opportunity to sell their shares at break-evens or slight profits, putting new downward pressure on the stocks. This means the whole self-fulfilling momentum that's usually created or was created during the Apple and Tesla stock splits might never end up coming. And that's because any rise in price is just met with new selling. Now, this doesn't make Amazon or Google bad companies to invest in, but if you're looking for a quick profit in Amazon and Google because of the stock split, it's less likely to happen this time around thanks to fears of hyperinflation, war in Ukraine, nuclear uncertainties, and fears of a straight-up recession. Of course, you could always just buy and hodl the shares and not worry about the fluctuations. Both Amazon and Google are great companies, and I would never bet against them.